Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is 23rd of June 2024 and it is a weekly markets update. So let's have a look at the news of week 25 and see what are the next trends. Egyptian urea production, being the hottest news of the past several weeks, seems to gradually be restored. Gas supply was resumed last week and producers slowly come back on stream. At the end of the week, most of producers ran production at 60 to 80% capacity, depending on producer, except Kima, which is expected to restart beginning this week. Global prices start to cool down, with deals being conducted at $5 to $10 lower versus the week ago across the regions. The other bearish factor is India, where urea stocks increased by 800,000 tons during May, reaching 11.3 million tons in front of the season. Thus, long-awaited tender that is expected for in July or August might not bring relief to the sellers, as its volume might be limited. On top of that, monsoon rains are not there yet, so the application is lagging. China keeps the intrigue in terms of urea exports, but at the moment there is no expectation for any exports in July and perhaps in August. Domestic Chinese prices are quite healthy for producers, and operation rates remain stable high, so no signs of quick reverting to exports. Other than that, there were no major sales from Southeast Asian producers last week. Only Brunei producer sold 2 cargoes, most likely to Australia. European demand is almost finished for this season, thus no major new purchases are expected. The market was not influenced even by the news of abrupt shutdown at Yara plant in Italy. In general, last week was slow due to Eid holidays, with both sellers and buyers inactive in many regions, including Middle East, Northern Africa, Turkey, and others. As a result of all those factors, Egyptian urea prices dropped to $350–$355 FOB. Proposals from Middle East producers are indicated at $335 to $345 FOB, but no new deals were registered. In fact, the only producers who increased pricing last week were Iranians, where proposals stayed at $305 to $315 FOB level. However, no interest from the buyers was seen. Also, CFR levels for major purchasing markets decreased. Like for Brazil, level dropped by $5 to $355–$365 CFR, and buyers pushed for lower rates for future purchases. NOLA urea prices dropped more than $10 to $93.10 for the short term. Paper values moved down in line with the market, showing $10 drop for July and August. FOB Egypt future for June indicated between $348 to $358, July $335 to $345, and for August $330–$340. Same tendency for NOLA and Middle East. So in fact, values come back to pre-rally level. One more news came from Pakistan. The country is in negotiations with Turkmenistan for supply of 200,000 tons of urea under government-to-government contract. We will hear more news this week, as government delegation of Turkmenistan will be in Pakistan as of tomorrow. Situation in ammonium sulfate segment, after price increase due to urea price rally and strong demand from domestic Chinese competitors, started to ease last week. However, prices didn't change much. Standard Capro grade product was indicated at $150–$155 FOB China, and granular product prices stayed in the range of $170 to $180 FOB. There were no major trading activity though. Demand from Brazilian buyers is much lower. They are mostly waiting for further price decrease because purchasing window is open for at least a month and a half more, so no need to rush. In nitrate segment, as well UAN, there is no demand, as the season is over both in Europe and US. So prices remained unchanged with no significant deals done. Buyers are satisfied with the stocks built for the next season, as well as sellers seem to be happy with sales into July and stock levels. Phosphate demand continues to firm, supporting further price increase for all products. DAP prices firmed by $5 to $10, and from some producers like Russia and Baltics, increase was more than $20. OCP sold about 47,000 tons of DAP last week in price range between $570 to $600 FOB for July and August loading, plus 42,000 tons of MAP at $570 to $590 FOB. Obviously, high commitments going into August will support firm price trend. MAP price skyrocketed by $15 to $20 amid strong demand in Brazil, Europe and US. MAP supply is very tight across the globe into August, so further increase might happen. Indian demand for imported phosphates is building up quickly, but still no clarity regarding subsidy correction came from the government. Importers lose money with current price level, and situation needs quick actions. There were 180,000 tons of new tenders announced last week that will close this week. However, most of them are those scrap tenders from the past. NPK prices are stable on the back of phosphates prices build up. Together with phosphate, India issued a tender for 80,000 tons of NPKs, closing this week. That will be covered most likely by Russian material. Demand in Black Sea markets for key NPK and NP formulas is strong and will remain strong throughout July, supporting sales from European, North African and Middle East producers. Moving to the fundamentals, European natural gas price fluctuates at the similar level versus last week. However, future prices are evaluated as increasing amid situation around Russian gas transit via Ukraine suspension in 2025. ICES issued a very interesting piece of analysis, which shows impact on prices due to potential transit cut. Their modeling results indicate that price increase that happened in May, after announcement of Austrian Gazprom gas buyer about potential cut of gas supplies earlier than end of 2024, was overreaction. Potentially the situation might be not that bad due to healthy stocks and steady LNG supplies, so the price might ease later in the year. ICES expects that effect on TTF price level will be minimal, with moderate price increase in Q1 2025 and then even decrease versus base scenario in Q2 and summer 2025. At the same time, LNG will be the key factor that will either support stability of supplies to Europe or otherwise create additional market pressure in the long run. Taking into account higher demand for LNG from Asian markets, as well as certain fears of a decline in US exports due to delays in construction of the Golden Pass LNG terminal, are heightening concerns about supply stability. Future markets in general agree with ICES, but demonstrate even higher price increase rates. Quarter ahead gas prices were higher last week than spot prices by an average of 7.5%. Season ahead prices, with an average value of 42.4 euros per megawatt per hour, tended to increase by an average of 22% compared to spot prices. We will see if indeed market reaction will be that significant, but uncertainty level is definitely high. For European fertilizers production, such high price level means that their competitiveness will be under question. And perhaps we might see production closures in the countries with the highest cost, which might happen in the middle of the hot fertilizer season. US natural gas futures fell again and reached $2.7 per MMBtu, as producers ramp up output to meet increased demand from power generations, as well as LNG exports. Analysts view this production growth as a response to the sharp rise in futures prices seen in April and May. At the same time, while gas flows to major US LNG export terminals are increasing, they are still below capacity due to maintenance in several Louisiana facilities. So uncertainty is indeed building up across the globe. At the same time, immense volume of gas flaring was registered in 2023, 148 billion cubic meters of gas, just imagine. As stated in the report by World Bank, this figure is 7% higher versus a year ago, and if utilized, it could have generated enough electricity to double the amount currently provided in sub-Saharan Africa. The leader of this anti-rating was Russia, which increased its flaring intensity by 13%, the highest ever registered level. The increase was seen in all oil-producing regions, indicating that it is a systematic problem. Most likely, Russia prioritized oil production without corresponding investments in the infrastructure to utilize associated gas. This is an indirect indication that global sanctions work, despite being extremely slow, and I hope this trend will continue. Agricultural commodities are under stress for the 6th consecutive week. Wheat futures traded around $5.8 per bushel, which is a 6-week low, due to expectations of increased wheat supply from the US, according to the latest WASD report. And this happens despite expectations for global supply reduction by 5.7 million tons due to significant production decrease in Ukraine, Russia, and the EU amid bad weather conditions. This downward trend is supported in large share by Turkey's decision to stop wheat imports from June 21 until at least October, leaving mainly Russian wheat to seek for other markets. So, while local Black Sea prices increase, global expectation is gloomy. Corn futures also dropped to below than $4.5 per bushel, reflecting abundant supply. At the same time, there is fear that highest since 2005 US corn stocks can flood the market in October and November, driving prices down. Now, US farmers refrain from selling, waiting for higher prices. However, demand for corn is robust as per USDA report, so a certain upward correction in prices might happen. Soybean futures stabilized around $11.7 per bushel, slightly up from a 6-week low amid expectations of higher supply and steady demand. The developments in the US crop offset the expected downgrade to Brazil stocks. But we need to watch the situation in Brazil further, as Brazil's president has issued an executive order that is awaiting approval, limiting commodity exporters' tax credits. This move can raise soybean prices as exporters adjust to higher costs. Moving to the shipping industry, we face another week of increasing indices. Prices for containers continue to grow, and seems like only sky is the limit. Putting the recent rate rises in context, the latest figure is 233% up on the same week last year and 260% above pre-pandemic rates in 2019. The industry expects further increase due to growing congestions in the Chinese ports and continuous problem in the Red Sea. As slowly we are approaching purchasing season for Christmas, there is no hope of lower rates at any time soon, unfortunately. This situation very badly influences prices in the specialty fertilizer segment, which usually travel in containers. We will discuss this topic in more details with Matthew O'Leary, Managing Director of Aquifert, in the interview this week, so don't miss it. The Baltic Exchange Dry Index showed 2.5% increase, again driven by demand for Capesize and Supramax, while Panamax index dropped. So this is the 3rd consecutive week of increases. To sum up, as we expected, there was more drama about Egyptian supply rather than actual problem. Sentiment in the nitrogen market becomes more bearish, and prices will fix somewhere at lower levels than those of week 25. On the contrary, phosphate market continues to be bullish with an upward trend. Agricultural fundamentals are quite gloomy, so there is not much place for bulls in the fertilizers market. So let's see what is next around the corner, but it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, and see you soon.